stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I've invited Kevin Cook, Zach's senior stock strategist, back to the Market Edge to talk about one of our favorite topics. When do you sell a stock? We last talked about this topic, it turns out, in January of this year, 2021. That was just 8 months ago, but it's coming up again because of this little pullback that we had seen in the big cap indexes, but really it's come back because we did have a 10% correction in the small caps. So people getting a little nervous, and they started tweeting at me, Tracey, when do I sell? What do I do? Please inform. And they might not have been around for the January 2021 podcast. And some of the things have changed a little bit since that podcast, I must say. Since then, the S&P 500 has made record highs 49 times. And here on August 24th, it's looking like 50 times since we last talked about this. And dozens of other stocks are still hitting their new highs. We've seen some of the rallies from last year continue into this year. Just a couple that are reporting earnings this week. Dick's Sporting Goods, DKS is the ticker. It's up another 95% year to date. That's just this year in 2021. Burlington Stores, another hot one. It's up 32% year to date, but it's up 338% over the last 5 years. Now, remember, the S&P 500 has also been hot over the last 5 years, but that's up only 103 or 104%. So Burlington Stores almost tripling the return of the S&P 500 over the last 5 years. And then, of course, we have some of the FANG names busting out again to new highs. Alphabet is up 61% year to date at new highs. And so that's one of the hottest of the FANGs. So here we are back again, Kevin, talking about what to do. Should we sell? What's happening?
Yeah, I didn't know that about Burlington.
Yeah.
But do they have some great online strategy that exploded too? Or
No, their online strategy is horrible.
Okay. Wow.
Stores. Yeah.
That's an amazing one.
Yeah.
You know, I went back and listened to our January 6th podcast. Let me see what you titled it. Should you sell your big winner stocks?
Okay.
Was the title you gave it from January 6th of this year.
Yeah.
And it was a good discussion because we talked about a lot of different stocks, but we also talked about general principles. And our main thing is always, before you sell a stock, revisit why you bought it in the first place. What was your goal and what was your time frame? And one of the things that I want to add to that, and I think people should go back and listen to that one, because we're obviously not going to review all the lessons in there. But one thing I want to add is that when you do buy a stock and you have this thesis, and let's say you think it's a disruptor, whether it's Tesla or Nvidia or Peloton or some software stock, once you're invested, you tend to do more research, and your antenna or your radar are tuned to all different sorts of news about that industry and the competition. And your thesis is allowed to evolve. You're going to learn more. So it turns out that I've initially bought stocks without fully understanding that industry, and then watched them go higher and decided to keep them because I learned more about that industry and their place in it. So you grow as an investor too with your stocks, so to speak, and your thesis may become more. You may end up with more conviction or less, but it's the learning curve aspect to me is what I didn't talk about then, and especially if you didn't understand how, for instance, Nvidia could grow into some giant total addressable market and then all of a sudden you learn how they could, then you're like, whoa, I never want to sell this stock.
Yeah. NVIDIA is up 67% year to date. Now, in full disclosure, I did own NVIDIA in the insider trader. I think we bought about in November of last year, 2020. And because one of the directors was buying around $500, that was pre-split, obviously. And so we were in it, but that's a short-term hold in there of 1 to 3 months. But I was patient. We stayed in past the 3 months. I think it was like 4, maybe even 5 months, but we just couldn't hang on much. It was like up and down and under where we entered, and we were in the red. And so I ended up selling it, Kevin. We got out, and then it soared. Then it took off again. So,
yeah. You had to endure a big sideways period there for the stock from, basically from last summer into this spring. A good 9 months of just going sideways, and that was a period where I was actually the opposite. I was like, "This is great. We want to be buyers here every time it gets near 500." And that was before the split. Yes. Split 4 for 1. And just because my analysis was that the company was sort of undervalued in terms of its real potential, because everybody thinks of it as a hardware company that makes chips. Yeah, they make fancy chips for games and for data centers and all this talk of artificial intelligence, but it's really a software company too. So because of what they embed in these stacks of hardware and software. So in my full disclosure, I will admit that I recently took some profits on NVIDIA, and in retrospect, maybe a little foolishly, a little early, because I thought we had sort of reached a maturity in the company, where everybody finally caught on. So while people were ignoring the stock, and now instead of talking about pre-split, I'll talk about actual split prices. So it seemed like everybody was sort of ignoring the stock at $130 last year, when you bought, right. and then, then they start to catch on. Yeah, this company's a real force, and they keep beating and raising every quarter. So after the last beat and raise, which was, let me take a look here, August 18th, I believe. Yeah. The stock, I said, okay, it's going to bump up against these old highs here of like 209 and 207. And I said, you know what? We've got most of what we wanted here. So let's just take a little bit, and I really only trimmed like less than 30% of what I had. And in some ways, it was a message to my followers and my members in Taser Trader that they should think about it too. Maybe take a little bit. But I was also being a little bit too cute, because I was trying to call a short-term top, like it wouldn't get through 207, 208, and we'd be able to buy it back when the market dipped this fall. We'd be able to buy it back at 175, 180. Well, like the day after I think I sold on Friday at 205 or something, or 206, it just vaulted. Yeah. Since then, and has traded as high as 220. So, the good news is I only took a little bit of profits, and it was from pandemic lows last year when the stock was $50. So we took like 285% gains on a tiny piece. And
yeah, we talked about this on the last episode we did on this, about
this is
just a small portion.
Taking a piece, right?
Yeah, and that makes sense.
Yeah, it does. And what's funny is people will say, Kevin, I thought you said always buy NVIDIA, never sell NVIDIA. I'm like, yeah, that's probably is my rule, just because they will dominate in so many of these areas with the hardware and software stack. But that's what it is. At least and sometimes it gives you a chance to reevaluate the thesis too. It makes you look harder at, because for NVIDIA, the big story is that the data center and artificial intelligence aspects are going to overtake the gaming. Gaming has always been 60% of the business, and then it's 55% of the business. Well, pretty soon this year, it's going to flip where data center applications will be half of the business, and they will overtake gaming in the next 3 years.
Yeah, I did not want to sell NVIDIA out of the insider trader, but because it is a short-term hold portfolio, and I wanted to move other things in, and we had held it longer than we normally hold. I did tell the subscribers that, if they're long-term investors, they should hold on to it. So I'm hopeful that some who were in it and maybe that follow your portfolio as well, and you were in it, that they stayed in it and were able to capture a lot of the upside that has happened on that one. But let's switch over to another stock that had huge upside in our January podcast, but it's basically gone nowhere. So it's kind of reflecting what NVIDIA did for those 9 months when it went nowhere, and that's Tesla. What's going on there? Shares are around 700. They traded as high as 900. They're up maybe like 1% for the year. As the S&P 500 keeps hitting those new highs, it's really underperforming for this year. Of course, it crushed it last year. But if you were a new investor who decided to buy in, earlier this year, you've gone nowhere. So what does an investor do with something like a Tesla?
Yeah, I mean, as you pointed out, the big gains happened last year where it was just like all this pent up energy just, catapulted the stock higher as the short thesis got destroyed and the bulls got joined. Last time I talked about Bailey and Kathy, two of the biggest bulls in Tesla, and that's Bailey Gifford, the Scottish investment fund managing well over 250 billion, and then Kathy Wood of ARK Invest, both the two biggest bulls on Tesla with huge positions that they had to trim because their profits were so big. Yeah. And they're sitting pretty because they still want to own the stock for another 5 to 10 years.
Right.
Yeah, for new investors getting in at, let's say you bought at 800 during sort of the melt up at the beginning of the year, 800 to 900. Yeah, you might be sitting for a while. Well, with that open loss as the stock consolidates and finds its next sort of catalyst. Is it going to be new models or increased sales or new the Cybertruck? I don't know what it's going to be. I sometimes I think Elon is trying to juggle too many plates, though. So he just this weekend he rolls out the robot, and then it turns out it was a human in a costume. So it's almost like he's making fun of himself again.
Right.
When is it coming? And the Cybertruck is getting delayed. I mean, his core business really is selling cars, these sort of luxury cars as EVs. And maybe if he stuck to that, but investors have lost no faith. So I can't really, if you've been an investor for even 2 years, hats off to you for sticking with Elon.
Yeah, he's getting a lot of competition now, I feel, in his core business. So we'll see how that turns out. What about Amazon? That's another one that's kind of just doing nothing. It's up 1.5% year to date. It did see the big surge last year, but now everybody's kind of soured on it, but it's not declining either. It's just kind of hanging out.
Yeah, and it's sort of the institution stocks, right? It's who can afford to buy it at $3,300?
Right.
So it if it dips below 3,000, I'm sure large investors will be coming to buy it just as as something they have to own. And I recently just did a series of videos and podcasts and articles on ESG investing.
Okay.
And was surprised to see how, Apple and Amazon are the top weightings in so many ESG funds. So
Yes.
it's like they've gotten an extra boost from that for somehow, scoring high marks for environment, social, and governance,
Right.
and that just feeds the big cap tech concentration that we see among institutional portfolios.
What about some of these other big pandemic winners, like a couple that we talked about last time, Chewy.com, CHWI is the ticker. It soared last year because they do online, pet supply sales, and everybody was staying home. Nobody wanted to go anywhere, so they had big gains, but shares are up just 1.3% year to date. And interestingly, on the January 6th podcast, we did talk about the stock turning over at that point. So we kind of called that one. But there's Chewy, there's Zoom Video we talked about last time. That's up only 0.3% year to date. Peloton, we didn't talk about it, but we should have. Peloton is now down 26% year to date, but still has a 55% gain over the last year still, even with the decline this year. But everybody thinks Peloton, Chewy, some of these names, this is peak earnings. When will it ever get as good as 2020 again?
Right.
Right.
Sort of like your Pinterest, right? Pinterest had this outsized year of 2020, and then they had to explain, hey, things aren't going to be as great as they were last year.
Right. They actually warned and tried to warn people that their huge subscriber gains wouldn't stick around, going forward, because the economy was reopening and people would have better things to do except just pinning all day. But some of these others, I haven't really heard them warning at all about that. Pinterest was one of the few that tried to, tell it like it was going to be. I did see PetMed Express. I don't know if you know them. They're an online pet pharmacy. They have come out now in their earnings reports recently and said, basically, things are never going to be as good as what it was in 2020, because the vets basically shut down, or you didn't want to go to a vet. And so to get your medications and things for your pet, you went on PetMed, but then once everything started reopening, everybody went back to the vet. And then the vet sometimes sells the medication on their own as well. So then you don't even need to order it online at all. So they admit that people went back to the vets and, sales declined.
That's unusual for a company to admit they're a one-hit wonder.
I know. So we are seeing a couple.
I'm glad you mentioned Peloton. I just want to talk about them for a second because like back in January, we talked about Chewy and Zoom, and I wasn't crazy about either of them just because I didn't think that they had strong enough brands to make a difference. Like anybody could go into the pet delivery space, and there were plenty of free options for video conferencing. You didn't need Zoom. So I didn't like either of those. But my mind is sort of evolved to Peloton as a very unique brand that is winning hearts and minds in terms of giving people this incredible, accessible workout experience anywhere they want. And so it seems like it seems like more of a disruptor than anything that Zoom or Chewy were doing. So so I'm sort of interested in Peloton, and I'll tell you another reason why. We both follow Howard Lindzen on StockTwits, the creator of StockTwits. He's also on Twitter, and he's an avid road biker. So he is out there hitting the asphalt a lot, but he also loves his Peloton, and he's an investor in the stock because he sees it building this ecosystem of fitness and apps and sort of that sort of thing that's sort of a sustainable brand for their growth.
Yeah, Peloton is kind of interesting to me because we all just call it Peloton, but its actual name is Peloton Interactive.
Okay.
And that kind of indicates to me that they want that interactive in the name because it's more than just that, bike that they sell. They do have the popular app that has like thousands of workouts on it. and they're not all done on the bike. So I know people who are subscribers to the Peloton app that do not have a bike because they just love the workouts on there, whether or not it's yoga or even just a walking type of workout, or, you know, an at-home mat workout or Pilates, any of that. Then you can also do all of that on the Peloton app. And that whole area, the wellness area is what I like to call it, is a big market. And if they're making some, you know, inroads in that area, then I might be interested in them too here.
Yeah. Hey, and you know, we just got all the SEC 13Fs last week. So it's kind of fun to see who was buying and selling. One of my favorite fund managers, Dan Loeb of Third Point, was a buyer of Peloton Interactive. He bought 600,000 shares in Q2.
Interesting.
Yeah.
Yeah.
And he's a smart guy. He's sort of a value quant, derivatives guy. He's not, he's very, he's pretty precise in the stuff he does. So this is interesting to see him put some money down there.
Yeah, it is still trading a little bit pricey on just a PE level for me as a value investor. It's trading about 190 times its forward earnings right here, but we're about to get earnings report again, so we'll kind of see what's happening and what they're seeing going forward. That'll be more interesting to me.
And since you mentioned that valuation metric, PE, which you have to use, it's part of your model for your value investor portfolio, I will just say that so much of what's going on in software ignores PE. It's not about profits. They just want to see the revenue growth. Right. So it's basically the rule of 40. If you can get a combination of revenue growth and margins that get you over 40%, then the stock is investable. So, you could have no free cash flow margins and 50% revenue growth, and the big investors are going to buy it based on, just that revenue growth, just that rule of 40 being in the mid double digits.
Okay. That's something to keep in mind. Definitely a lot of different ways you could play value or, things that are on sale these days. And speaking of on sale, we've already done a podcast on Chinese stocks after those have been selling off, but we did mention them on the January 6th podcast. And we specifically talked about Baba because you had owned Alibaba in one of your portfolios, but you had been selling some of it in January, and now you look like a genius.
Well, I mean, I did say the right thing at the time, and it was sort of, I was coming around to your thinking. You ran away from Chinese stocks a couple of years ago when the government took action against Tencent. And I thought, well, Baba is, Baba will be fine. But in January, I was talking about, listen, the Communist Party just came in and told them you can't do the Ant IPO, and the Ant IPO, that was going to be like the PayPal of China, basically. And the government just stepped in and said, no, you're not doing that IPO. And it was like, whoa, and there was kind of a slap in the face to Jack Ma. And I just said at the time, you could never fight the government or regulation. It can just tear the foundation out from underneath an industry or an investment. So I sold some, and then I was looking to redeploy, see what happened, and then I was buying again around 200 in Baba, and then the wheels started to really fall off this summer. They had this IPO for this company called is it Didi?
Yes.
Yeah. So Didi does this IPO, and I guess they did it without permission from the powers that be in China, which is kind of a no-no. And basically, the thing IPOs at, let's say, $14, it's now trading for $8 because the Chinese government said, no, I think it's an app involved with autonomous driving, so it could track a lot of people's data. And the big thing is that the Communist Party didn't want anybody outside of China having access to Chinese consumer data for one, and they didn't like the fact that all these companies are IPOing in, New York and making a few people rich. You've been talking about this for a while about it's sort of the revolution against the billionaires.
Yeah.
But yeah, it made these companies uninvestable when you realized they didn't care if they cut the market cap in half of any of these companies. They didn't care if they cost investors money in Baba or Baidu or Didi or JD or any of these. They just didn't care. And when you can see that they don't care about hundreds of billions of dollars just evaporating because they just want power and control, boy, that's the red flag to really get out. So I finally sold the last of my Baba and Baidu at like 12% losses in July once I finally saw the writing on the wall.
What about people who are still in them now? Should they stay in because the sell-off has been so extreme? Should they dollar cost average? Should they just get out?
Yeah. Well, I mean,
this depends on your, a lot of things.
If somebody went into this storm, and was willing to sort of ride out the uncertainty, then they probably, are not too shaken now because they were thinking that it's a long-term thing anyway. Like the reason I want to own Baba is because this is, to me, it is the Amazon of China, and it has access to the largest middle class in the world. You're talking about a middle class of arguably 600 million people. And so if you want access to that market, Baba was one of the ways to do it. Yeah. So if you are willing to ride it out for 5 or 10 years, you'll probably do great. If for anybody who just got in for a trade and like they were buying at, 170, 180, you have no idea how low this could go. I mean, what was the company that they basically wrecked and took private? Oh, Kihu 360. Remember them?
That's right.
Kihu 360 was sort of a social media company. I owned it a couple of times, and the Chinese somehow spread rumors to take the stock down. They basically cut it in half and then took it private and then IPO'd it 2 months later and made a bunch of people rich within China. So these when they're willing to go to these sort of mobster measures, then the short term is very cloudy.
So have you sold, other than NVIDIA, have you sold anything else, in August here on this weakness that we're seeing in the overall market?
I did. I took a little profits in Square.
Okay.
And I looked smart there because I was just looking at the chart and it was like we'd made new highs. So once again, my thesis was we were just, every time it dipped to 200, we wanted to be buyers. So we make new highs above 280, but you can tell by looking at the chart, there was some big sellers up there, 280, 285. So I was looking at the market going, I was thinking the market would correct into September. We'd have some weakness. Yeah. So you know what? So I sold some at 276 and I said, let's be buyers, 250, 260. Well, that transpired in about 10 days, but you had to be quick if you wanted to buy any at 255 because now it's back up to 270.
Wow.
So at least I didn't sell all my Square, but again, I was trying to be cute on the timing thing. And that's the thing, big investors. I mean, when you think about what an institutional investor does, money comes in, he only has to answer to his clients once a quarter, and they have to buy with that money. They can't sit in 20% cash, and they don't really have to sell. So, a lot of times they're not going to play around for, 10, 20% gains when the upside could be explosive and they might miss it.
Yeah.
And I think Square will go to 350 in the next year. I think we'll see 350. So I definitely want to build my position back up when I get a chance.
Given that we've had this kind of quick shift back to the bulls here, and it's not quite September yet. Does this change your theory about the weakness heading into September?
Well, I think it's still a pretty high risk.
Okay.
And I mean, it's seasonal, and we're looking at unemployment benefits expiring in 2 weeks here.
Right.
And we don't know really how things are going to unfold with the new Delta variants of the coronavirus. So I think there's enough uncertainty, and we've run so hard and valuations are so stretched. That's usually when you get a sneaky little 5 to 10% correction out of nowhere.
Right.
Now, trying to time that though is the tricky part. I'm looking at Shopify. We had some nice trades in Shopify this year, and I wanted to get back in, and things were just setting up perfect. By the end of last week, stock was back down to $14.50, and I'm like, this is going to be great. We're going to dip next week. I'm going to get to buy more Shopify under $1,400, and today it shoots back up to $15.50. So
yeah, I saw those energy stocks rolling over because I owned a couple of them in my value investor, and I owned one in the insider trader. And I had to sell all of them because we were not just at 10% corrections on a couple of them, we were at 20%, the bear market. And usually when energy has, a big correction like that, it somewhat signals that there could be one coming in the overall market. But so far that's rebounded too off of those lows and is now kind of back to being not completely back to break even, but it's looking a little more bullish. Now, I did see from Ryan Dietrich at LPL Financial, he's on Twitter and he's always posting these interesting stats. And he said that we've had 9 new highs in the S&P 500 here in August. And that's the most in August since 1929 when there were 11.
Wow.
That year, even more than like the boom years of the 90s, because as you just mentioned, August is usually the slow month. It's usually when everybody's at the beach and then they're getting in one last vacation before the kids go back to school, and it's kind of quiet. Nobody's really paying attention. So it's rare to get like a rallies like this where you keep hitting these new highs. So is it different this time? Is something else going on?
Well, when we talk about long-term investing and why people put their money in the market and keep it in the market and hold on to stocks for years and years, what are those long-term drivers? You've got an economy that's growing, so the U.S. economy isn't perfect by any means, but it's got some pretty steady growth, and it's got a huge backstop of monetary policy, which is certainly a tailwind. And then money just pouring in, right? There's, just trillions is earmarked for stocks. The wealthy have money, and then where do they put it? They put it, they give it to their money manager, and who has to buy stocks. And then you've got the technology innovation. So like all these things come together, and then demographics, right? I would say technology innovation is more important than demographics, but demographics are clearly, part of your economic growth too. You did a big thesis last year about basically the coming housing boom, and I'm all on board with that. Once I looked at the generational things that we're going to get. I mean, we're already looking at this mini housing bubble, but when you and I talked about it last year, it was more that demographically speaking, for the next 10 years, we're going to see. We're going to see this generation, millennials, buying houses, settling down, cars, home improvements, schools, hospitals, and everything that goes with that. And that's all great for the economy long term.
Yeah.
But the technology aspects that create new industries and disrupt old industries, investors are really tuned to this. So you have trillions of dollars sitting at some on the sidelines waiting for either a correction or the next move higher. And the safe bet has been the next move higher. So if you sit in cash, you really miss, all the tailwinds that push stocks higher. And are we in a bubble? I mean, when you look at things trading 20 times sales, like, Nvidia was trading 20 times sales. Seems kind of bubbly, but that's what the software component of the market does. It trades at 20 to 30 times sales and more, maybe 40 times sales. And so, I think investors have learned that you better err on the side of being bullish, because there's really nothing that can take this market down. What happened with coronavirus, what I call the corona crash, was exactly that. It was just a panic that, oh my gosh, we're shutting down the economy, everybody stay home. Yeah, that does seem really bad, but it got overdone. And, and that's where some great buying opportunities were. And there's really nothing like that on the horizon to scare the market. Nothing about, tax policy or capital gains. I don't even think that a small coronavirus shutdown could dent this market right now more than 10%.
So any final advice about when to sell? Because it is among the hardest things, I feel, for investors.
Yeah. I mean, I guess I would just go back to the thing we did in January. I talked about how people make buying decisions. When people make decisions to buy a stock, they're usually looking for 3, 4, 5 things to line up, in terms of valuation or industry or innovation or, these kinds of things. So if you have a decision matrix that gives you the thumbs up on a buy, and then you kind of have an objective in mind for that stock, that industry, and your time frame, I think you should also have a decision matrix about selling. And most of the professionals do. When I say professionals, I mean big institutions like a Bailey Gifford. They're not just sitting around flipping a coin or looking out the window and saying, what should I do? They've already built models to tell them, when something has moved, way beyond what, where they would start new positions or what they were willing to pay. And then maybe they just reevaluate. They're like, okay, what is actually happening in this industry? What is the total addressable market of software analytics or electric vehicles? And then, they dig into it. So have a matrix to decide when to sell too. And the thing I mentioned earlier was you evolve with the investment, because once you're in it, then you're paying more attention to that industry and that company. You're on the conference calls. I mean, look at you with like some of your favorite companies like Restoration Hardware or some of the home builders. You're on those conference calls quarter after quarter. You're learning more about the company, and that gives you conviction that other investors don't have. So that's sort of your edge, is that while people are like, there could be a headline on CNBC about why they're selling the home builders or why they're selling Restoration Hardware, and you're like, that doesn't faze me at all, because I already knew, XYZ from listening to the last 6 conference calls, right?
Right. Or even like Pinterest. They warned in the conference calls ahead of the latest one that everybody finally listened to the warning and saw the warning in the numbers dropping. They warned on those conference calls ahead of time that the numbers, likely wouldn't stay elevated and that they were going to see a pullback. They never gave any guidance because of the ongoing pandemic and the uncertainty, going into it. So they just said, we're not giving any guidance, but we warn you that we don't see it staying this strong, in a reopening type of scenario, which we got. So yeah, if anybody listened to those conference calls, they would have known already. So yeah, it's a good little key there. Okay, so have a plan and follow your plan, know your goals, listen to those conference calls, and you will feel better at least. Okay, let me go
and
over.
You'll get smarter too as you do more research, right?
Sure, for sure. Yes, that makes you feel better too, I feel. Okay, I'm going to cover a whole bunch of the tickers that we did on this episode. There are a lot, as always. So I briefly mentioned Dick's Sporting Good. They're almost doubled their stock this year. DKS, Burlington Stores, BURL, Alphabet, of course, GOOGL. We talked briefly about Amazon, AMZN, NVIDIA, of course, NVDA. Then we talked about Tesla, TSLA, Alibaba, BABA, Chewy.com again, CHWY, Peloton, PTON, Zoom, ZM, Square came up, SQ, DD is the China IPO, DIDI, Shopify was mentioned as well. SHOP. I think that covers most of the main ones we discussed. But this is a good discussion yet again, and good to look back on what we thought was happening in January. Now here we are 8 months later, well into the reopen now on the economy, and a lot of what we thought may hold did happen. And so this is always good to revisit these kinds of issues, especially when so many people have these big winner stocks and everything's trading at the new highs. So we'll regroup probably maybe back again in 2022 and see what's going on then. So you want to be sure to subscribe so you don't miss a single one of these podcasts. And then you won't have to tweet at me and ask me, like, when are you going to talk about selling stocks? Because you'll be listening in. And you can get us everywhere you can get podcasts. We're on Apple, we're on Spotify, we're on Amazon Music, we're on SoundCloud. Get us at all the podcast platforms, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.